All right, y'all, we have a ton of stuff to get to today on Real Estate Backstage, and that's because I've been out the last several weeks. It's been 4 weeks now, I think, since I've recorded an episode. So I was out for a couple weeks visiting family in Austin, Texas, and then when I got back in town, I was just pretty bogged down playing catch up. You guys know how it is. So here we are, Friday, July 4th. We are back to recording Real Estate Backstage, and we are just going to jump in. So if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe to the show, that way you don't miss any future episodes. And if you're looking for the show notes with links to all the articles that we're going to cover today, you can find that at realestatebackstage.com/episode 32. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. Now, before we jump into the news, last time on the show I mentioned that we were currently interviewing for a managing broker position here at Bluefield, and that's been an interesting process over the last month or so, meeting with a lot of people, having a lot of interesting conversations. What really has struck me as fascinating is the number of people that applied for the role that are currently serving as broker in charge of another company. We've had BICs from a handful of smaller companies and even a couple BICs from larger companies that have applied for the position that I've had the opportunity to sit down and interview with. And one of the recurring themes that's really coming up over and over and over again in conversation is the growing misalignment between risks and rewards for brokers in charge of real estate firms. Now, the cost of everything is going up. So that's the cost of insurance, the cost of legal compliance, of office space, of staff members, lead generation. Costs are going up due to inflation. Regulatory uncertainty is pervasive throughout the industry. There's a lot of lawsuits going around. We've actually been named in one of the copycat lawsuits to the Sitzer Burnett case that, knock on wood, is hopefully going to be dismissed by the end of this year after the NAR settlement finalizes the appeals process. And we've had to shell out thousands and thousands of dollars of legal expenses just to respond to a lawsuit that ultimately is going to be dismissed, which is pretty frustrating. But not only are expenses going up, gross margins tend to be declining on an industry average basis. So broker owners and BICs, they're making less and they're spending more. And so there's a lot of growing pressure, not just on real estate agents, but really on brokers. So if you do work for a good broker, make sure that they know how much you appreciate them. Typically as BICs, we tend to get the problems. We have the bad scenarios. So, our days tend to be filled with putting out fires and dealing with negative circumstances. So if you do work for a good broker, make sure just to let them know that you appreciate everything they do. But yeah, just over the last several weeks, having these conversations with a lot of BICs at other companies that are interested in potentially coming on board here at Bluefield as one of our managing brokers, it's just been really eye-opening to see just the level of frustration and discouragement in our industry right now. All right, so let's jump into the news. Of course, the big breaking news of the week is that Trump's big, beautiful bill has passed through Congress. This is according to the White House. Quote, the House of Representatives just officially passed the One Big Beautiful Bill, giving final approval to President Donald J. Trump's landmark legislation in what is being called the biggest legislative win of President Trump's 2 terms. Now, the largest middle-class tax cut in American history, and so much more, is on its way to President Trump's desk, unquote. So this bill, of course, has been hotly debated, not just among politicians, but people all across America. Lots of provisions in the bill that people are upset about, whether you're on the left or on the right. Of course, there are many critics of the bill. Some believe that it doesn't go far enough in achieving spending cuts and that it will continue to add to our deficits and growing debt. And then, of course, there are others that believe the bill cuts too much into key programs by instituting work requirements for Medicaid and other means-tested welfare programs and things like that. One of the things that will certainly impact the real estate industry is the cap on SALT deductions, which is state and local taxes. Because property taxes are paid at the local level, that does fall within the category of the SALT deduction. So this bill, of course, will maintain the ability for homeowners to write off the property taxes that they pay on their primary residence when filing their federal income tax reports. All right, so let's get to more economic news in general. So because I was out the last several weeks, we've got some May and some June data we're going to go over. So the May jobs report did top expectations. This is according to Connect CRE. Quote, U.S. non-farm payrolls increased by 139,000 in May, slightly above the 125,000 forecast, while the unemployment rate held steady at 4.2%. the Bureau of Labor Statistics reported on Friday. However, job gains for March and April were revised down by a combined 95,000 positions. The labor force participation rate edged down to 62.4% in May from 62.6% in April, signaling a slight pullback in workforce engagement. Meanwhile, average hourly earnings rose 0.4% for the month, doubling April's 0.2% pace and exceeding the 0.3% consensus estimate. On an annual basis, wages increased 3.9%, outpacing the 3.7% forecast and holding steady from the prior month, which was revised up from 3.8%. Despite signs earlier in the week pointing to labor market cooling, such as a rise in initial jobless claims to the highest level since October, and private sector data showing the slowest hiring pace in over 2 years, the May report underscores continued resilience in job creation. The data support the Federal Reserve's cautious stance on interest rate policy. With inflation risks still looming and heightened trade policy uncertainty, Fed officials are expected to maintain their wait-and-see posture. The report makes it highly likely the Fed will hold rates steady at its upcoming meeting later this month, unquote. Now, that was the May data. In June, we had another strong jobs report that exceeded expectations. This is according to Inman. Quote, the U.S. economy added 147,000 jobs in June, curtailing hopes of another mortgage rate drop amid slowing home buying and home selling activity. The Bureau of Labor Statistics report exceeded analyst expectations by 37,000 jobs, as unemployment rates dropped 3% month over month to 4.1%. The majority of job losses came from the federal government due to the Trump administration's months-long mission to streamline multiple agencies and departments. Bright MLS chief economist Lisa Sturdivant said the June report reflects the strength of the U.S. market despite a topsy-turvy trade and interest rate environment. There have been expectations that the June jobs report would indicate that businesses were holding back on hiring as a result of uncertainty around tariffs and elevated interest rates, she said. But there were strong gains in employment in the healthcare sector, while state and local governments also ramped up hiring in June. The June report included a 7,000 drop in government employment, but again, this was far less than had been expected, unquote. So we had 2 months in a row here, May and June, of very strong jobs reports that did exceed expectations. That shows that the labor market is being very resilient. So the economy seems to be on pretty solid footing. Despite all of the uncertainty and this general feeling that we're about to see some economic turmoil, the actual data, the backward-looking data has been pretty solid, which I believe is going to continue to give the Fed reason to pause. As long as the economy is doing well and the labor market isn't breaking, as we've talked about multiple times on the show, as long as those things aren't happening, there's really no rush for the Fed to cut interest rates and be less restrictive in their policy. Now, we did have some inflation data come out as well. This is the May CPI report, which cooled slightly. This is according to Connect CRE. Quote, the consumer price index rose 0.1% month over month, below the 0.2% consensus and April's 0.2% pace. On an annual basis, headline CPI increased 2.4%, slightly under the 2.5% estimate, and up from 2.3% in April, according to the Bureau of Labor Statistics. Core CPI, which strips out food and energy, climbed just 0.1% for the month, sharply below the 0.3% forecast, and April's 0.2%. On a year-over-year basis, core inflation held steady at 2.8%, just below the 2.9% consensus. Shelter costs rose 0.3% in May, making it the largest contributor to monthly increase in overall prices, according to the BLS. Food prices also climbed 0.3%, while the energy index declined 1%, helping to offset some of the upward pressure, unquote. So we have the labor market, which has been very steady, very resilient, not breaking. And then we have inflation, which continues to cool, continues to come in lower than expectations. So it appears that the Fed has been so far able to achieve that soft landing that they hoped for, taking a restrictive monetary policy and bringing down inflation without breaking the economy and causing negative consequences in the labor market. So the Fed, of course, did decide to hold rates steady in their June meeting based on all the things we just talked about. This is according to RIS Media. Quote, at the latest Federal Open Market Committee meeting on June 18th, the Federal Reserve Board of Governors once more chose to leave interest rates unchanged from the current 4.25 to 4.5% rate. Interest rates were last cut in December of 2024. At a press conference following the meeting, Federal Reserve Chair Jerome Powell stressed that the economy is on solid footing between low inflation, though still not quite at the Fed's goal of 2%, and a strong labor market. Wage growth has continued to moderate while still outpacing inflation, said Powell. While the economy remains stable, uncertainty about the future of the economy is greater than before due to tariffs. More Fed members predicted there would be no rate cuts this year than the last time that the FOMC released economic projections, though a majority still expect 2 rate cuts by year end. Throughout the press conference, Powell claimed that the strong economy means the Federal Reserve is in a fortunate position of being able to leave monetary policy unchanged so as to wait and see for the impact of tariffs. For the time being, we are well positioned to wait and learn more about the likely course of the economy before considering any adjustments to our policy stance, said Powell, also stating that the current stance of monetary policy leaves us well positioned to respond in a timely way to economic development. President Donald Trump has consistently pushed Powell, who he first appointed as Fed chair in 2018, to cut interest rates since taking office, though Powell has emphasized Fed independence while avoiding conflict and any direct public comment on the criticism. Powell did meet privately in person with Trump last month. The effects of tariffs are projected to begin showing up in economic data this summer, Powell, citing one reason why the current economic data does not reflect the impact of tariffs, explained that goods being sold at retailers today could have been imported several months ago before the tariffs, unquote. So Donald Trump, of course, has been very vocal, very upset about this, and in recent weeks, he's really stepped up his public pressure campaign against the Fed and against Jerome Powell specifically. However, Jerome Powell seems to be holding steady and not buckling to the pressure, continuing to reiterate Fed independence, and that the reason for delaying cuts to interest rates is really based on the forecasts, which show that inflationary pressures are likely to come based on the tariff implementation. Now, I do have to comment that if you zoom out and look at Fed policy over the last 75 years or so, rates are actually not that high. The Fed policy right now is certainly restrictive relative to what it was in the 2000s and the 2010s. But when you look back over the long term, that is just not the case. And for those of you watching on YouTube, I've got this chart up on the screen where you can see the effective federal funds rate over the last 75 years or so. And you can see that, yes, as of the moment, we're a little bit higher than we have been in recent years, but we're probably pretty darn close to what the average effective federal funds rate has been over the past 75 years. All right, in other news, price cuts are up as a percentage of active listings. I've got another chart I want to put up on the screen for those of you watching on YouTube. This is courtesy of Housing Wire, and this shows the percentage of properties that have had recent price reductions. As you can see, as of right now, about 39% of active listings across the country have recently dropped the price. This, of course, is higher than any other recent years at this time of the year. Typically, we do see price reductions fluctuate a little bit throughout the year, but you can see the big gap, how big of a difference that is right now compared to what it was back in 2022, for example. But of course, 2022 is the year that we really saw the real estate market change. We went from 3% mortgage rates to 7% mortgage rates, I believe, within like a 6-month period of time. So, starting in late spring through early fall, we really saw the real estate market slow down during that period of time. And ever since then, the market has been dramatically different than what it was in the immediate post-COVID era. All right, so shifting gears, consumer sentiment about housing has rebounded. This is according to Inman. Quote, consumer sentiment about the housing market improved in May to the highest level since November, as Americans become more optimistic about buying and selling conditions and the prospects for mortgage rates to come down in the year ahead. Fannie Mae's latest national housing survey, released on Monday, showed 5 of 6 components of the mortgage giant's home purchase sentiment index improved in May. Consumer sentiment has been trending down this year, in part due to fears about the impact of the Trump administration's tariff policies, but the economy continues to do better than surveys suggest, economists say. While only 26% of household decision makers in May said that this was a good time to buy, that's up from 23% in April and 14% a year ago, which was an all-time survey low. With the share who said May was a bad time to buy falling from 77% in April to 74% in May, the net share of consumers who said it was a good time to buy increased by 7 percentage points to underwater by 48 points. More than 2/3 of consumers surveyed, 68%, said they'd buy rather than rent if they were going to move. That's up from 65% in April, unquote. So that is good news. I think a lot of homeowners are starting to get used to this as the new normal, with mortgage rates being what they are. Regardless of all this economic uncertainty and fear about the future and elevated interest rates, tariffs, everything that people are thinking about these days. Despite that, we still see the vast majority of Americans would prefer to buy rather than rent. All right, housing starts were down 10% in May. This is according to Inman. Quote, new residential construction showed mixed signals in May, offering glimmers of progress in completions, but largely falling short on starts and permits. According to new data released Wednesday by the U.S. Census Bureau and the Department of Housing and Urban Development, the broader picture shows stagnation rather than recovery. Privately owned housing starts dropped 9.8% from April to a seasonally adjusted rate of 1.256 million. That figure is also 4.6 below the May 2024 rate of 1.316 million, marking the weakest pace since 2020. The steep drop is not entirely surprising, considering that builder sentiment in June reached one of its lowest levels in 13 years, the only exceptions being April 2020 and December 2022, Kushi explained. This growing builder pessimism was widespread across all HMI components. Optimism about single-family sales for the next 6 months dropped by 2 points, and current sales conditions also fell by 2 points, marking the lowest level since June of 2012. Prospective buyer traffic decreased from 23 to 21, unquote. So the new construction market is showing signs of weakness, and that has been really a big bulk of the housing market's resiliency over the last several years has been the new sales market. While we saw existing home sales really crater, new home sales have fared relatively well. I think a big part of that has been the builders' ability to buy large bags of money to be able to offer decreased mortgage rates to home buyers. All right, in other news, real estate investors are unloading homes at a record clip. This is according to Inman. Quote, real estate investors are offloading homes at a record pace, but not to cash in. They're trying to stem losses as the housing market cools and rental prices soften, a new report from Realtor.com found. In 2024, investors accounted for 11% of all U.S. home sales, which is the highest share seen in over 2 decades. That translated to about 509,000 properties sold, a sharp increase from pre-COVID levels. The median sales price for these homes was $330,000, the Realtor.com data shows. The reason behind investor sales has shifted since the COVID-19 pandemic heyday, Realtor.com senior economic research analyst Hannah Jones wrote in the report. Investors may no longer be selling to cash in on soaring home values, but rather due to market softening and easing rents. The change in investor activity isn't isolated to one type of investor either. From mom-and-pop landlords to industry giants, all investor groups sold more homes in 2024 than they did in the year prior. Despite the sell-off, investor buying hasn't disappeared. In fact, it ticked up slightly, with 13% of all 2024 home purchases made by investors, up from 12.7% in 2023. Though modest, this increase in investor home purchases came at a time when overall home purchasing slumped, resulting in an uptick in investor buyer share, Jones said. So we're definitely seeing this on the property management side of our business. A lot of our owners have decided to sell in recent years. There's a variety of reasons for that. Owning rental property right now is probably more challenging than it's been at any point in the last couple decades. Due to inflation, we're seeing, soaring costs for insurance, repairs, CapEx. Because home values have appreciated so much, we're seeing property taxes go up. So with costs going up and rent growth being pretty flat, at least in our market, rent growth is pretty flat year over year. I know that's the same in lots of markets across the country. With softening rents and raising expenses, margins are being compressed. If you're highly leveraged, if you have a high interest rate, it can be pretty hard to be profitable, especially if you have an above median value rental. As you get up in the upper price ranges, the rent as a percentage of value just doesn't really keep up. It can make it hard to pencil out the cash flow. So unless you have a good amount of equity, if you're not highly leveraged, but a lot of our owners have decided that it just makes sense at this point to cash out, not because of the values going up so much, but because of the compressed margins and reallocating those funds to somewhere else where they feel they can get a higher return on equity. All right, so shifting gears, the CFPB enforcement chief has resigned. This is according to Inman. Quote, the Consumer Financial Protection Bureau's enforcement division will be under new leadership for the 3rd time during the Trump administration after acting director Kara Peterson resigned Tuesday, saying in a farewell email that the Bureau's current leadership has no intention to enforce the law in any meaningful way. The Trump administration is seeking to cut 90% of the CFPB's workforce and has put the brakes on about 20 active enforcement cases, Bloomberg Law said in breaking the story of Peterson's departure. The New York Times, which also obtained Peterson's farewell email, said she took over as the acting head of enforcement after her predecessor, Eric Halperin, resigned in February. Peterson has worked at the CFPB since it was created in the wake of the 2007 to 2009 financial crash and Great Recession. I have served under every director and acting director in the Bureau's history, and never before have I seen the ability to perform our core mission so under attack, Peterson wrote to her colleagues. It has been devastating to see the Bureau's enforcement function being dismantled through thoughtless reductions in staff, inexplicable dismissals of cases, and terminations of negotiated settlements that let wrongdoers off the hook. The CFPB did not respond to Bloomberg Law's request for comment. Under the leadership of Acting Director Russell Vogt, the Chief Legal Officer Mark Paoletta, the CFPB has not only halted active enforcement cases, but moved to vacate or weaken several finalized settlements, Bloomberg Law reported. The CFPB's unprecedented attempt to undo a settlement in a fair lending case that the government reached with a Chicago mortgage broker last year would establish a dangerous and destabilizing precedent, if granted, according to fair housing and consumer protection groups opposing the move in court. The judge in that case hasn't ruled on the CFPB's request, unquote. Now, in fact, the judge actually, in that particular case, did end up denying the CFPB's request after that article was written. So I'm a big fan of smart deregulation. I tend to agree with those who are critical of the CFPB, specifically around how it was created structurally so that it's not funded directly by Congress. But I do believe that the CFPB has done and should continue to do great things protecting the consumer. It's really important to have an enforcement mechanism at the federal level that's looking out for consumers, making sure that these companies aren't taking advantage of people and breaking the law. So I think from the outside looking in, it appears that maybe a chainsaw is being used when a scalpel would be more appropriate, trying to pare back the CFPB. I think legislative reform would make more sense. To try and get that done through Congress. I know with current rules in the Senate with the filibuster, it'd be really difficult to get that done because they would need 60 Senate votes, not just a simple majority. But I think just going in and completely cleaning house and trying to reduce force by 90%, halting enforcement action, going back to prior settlements and trying to undo them or change them, I think it is pretty dangerous. So the administration does need to be careful on that front, in my opinion. All right, shifting gears, the Realtor.com CEO Damian Eales has slammed private listings, this is according to Inman. Quote, amid a raging debate within the real estate industry over private listings, Realtor.com CEO Damian Eales on Monday slammed advocates of the idea, calling their arguments utter nonsense and suggesting they will find themselves on the wrong side of history. Eales made the argument in a blog post in which he praised the U.S. real estate market for uniquely giving buyers fair access to all properties. He also noted that as an Australian, he has firsthand experience selling homes where the principles of clear cooperation do not apply. Clear cooperation is a National Association of Realtors rule that requires brokers to put their listings into their local multiple listing service within a day that they begin marketing. The rule has been polarizing, but NAR recently opted to keep it in place, albeit with a key modification. In his blog post on the topic, Eales' most incendiary comments ultimately came several paragraphs in, when he said, it is anathema to common sense that more and more sellers want the choice of fewer free eyeballs. More likely under the influence of those who should know better and those who have a fiduciary obligation to serve their clients' interests, some sellers are seduced into believing that less is more, Eales wrote. It is utter nonsense and never more so in an emerging buyer's market. The comments tap into the ongoing debate over private listings, which are for-sale homes that are marketed exclusively between brokers or via a broker's platform, but which do not go into local multiple listing services. Compass and its CEO Robert Refkin have been the industry's most vocal advocates of the concept, rolling out a three-phase strategy that sees homes begin their journey on the market as private listings. Though Compass has been the most proactive voice in favor of private listings, other brokerages have also rolled out their own private listing networks. However, opponents of the concept have been equally vocal, and earlier this year, Zillow and Redfin both said they would ban homes from their platforms that are marketed privately. Zillow began warning brokers that their listings are at risk of being banned earlier this month. Eales revealed in his blog post that Realtor.com's relationship with MLSs require the company to show all listings, meaning the site will not follow Zillow and Redfin's lead in banning privately marketed homes. However, he did say that Realtor.com is open to working with MLSs who want to better enforce the principles and policy of clear cooperation. He also said that cooperation is what enables this free and open marketplace and criticized those on the other side of the debate. Why should an uncooperative listing agent be able to sell privately to a restricted group of buyers agents and buyers and at the same time benefit from unrestricted access to the listings of cooperating listing agents? Eales asked in a blog post. Why should sellers be able to access the value of the very MLS they diminished by being uncooperative? One shouldn't turn up to a potluck dinner carrying only a fork. I love that line. Eels did mention some genuine fringe cases, suggesting there could indeed be times when a private listing is warranted, but he rejected the idea that such cases are widespread and offered a warning for private listing proponents. Brokers who facilitate private marketplaces, Eels said, are likely to find themselves on the wrong side of history by putting themselves in the bullseye of litigation from both sellers who feel shortchanged, as well as buyers who claim they were selectively excluded from seeing a property, unquote. So I tend to agree with Damian Eels on this one. I actually had the opportunity to spend some time with Damian and a few other members of Realtor.com's leadership team at a dinner in Vegas a couple years ago during the Inman Connect event out there. This was shortly after he stepped into his new role as CEO of Realtor.com, shortly after moving to the States from Australia. From my limited experience interacting with Damian, he seems like a very genuine, down-to-earth guy. We had lots of great conversation that evening and in the weeks following that. He mentioned that when he was living in Australia, the real estate market there is very, very different. It's very uncommon for a buyer to be represented by an agent. Typically, only the sellers have representation. There's a lot of off-market transactions, private transactions that happen in Australia. Because of that, he's a big proponent of buyer's agents, of sellers having the flexibility to offer buyer's agent compensation, and he's a big supporter of NAR's clear cooperation policy. All right, so in that vein, Compass has actually sued Zillow over their private listings ban. So this is according to Housing Wire. Quote, Compass, the largest real estate brokerage in the country by volume, has sued Zillow over its policy on private listings. Compass filed a lawsuit in New York on Monday, alleging that Zillow is breaking federal antitrust laws by permanently banning any listing that isn't put on an MLS within a business day of being publicly marketed. To protect its market dominance, Zillow has retaliated against competitive threats by enacting an exclusionary policy, Compass argued in its lawsuit. Zillow says its new listing policy is enforcing the National Association of Realtors' clear cooperation policy and ensuring transparency in the market. Redfin, which has taken a similar position, was named as a co-conspirator in the suit, but not as a defendant. Compass currently has about 7,000 private exclusives. That's what they call their off-market listings, their Compass private exclusives. Rivals argue that Compass is merely trying to double in deals to increase profits. Zillow and a host of brokerage critics say that preventing listings from hitting the public market undermines progress made in creating a more transparent market for consumers, unquote. So I tend to agree with Zillow and Redfin and Realtor.com on this one. I think Compass is probably going to find themselves on the wrong end of some lawsuits here. I do believe that, like Damian Eels said, there are some fringe cases where a private listing might make sense, but I think the vast majority of the time, NAR's clear cooperation policy is what's in the best interest of the consumer, and having a open, transparent market where the seller gets the most exposure and the buyer gets to see everything that's available is going to make the most sense. It makes for a more efficient and fair marketplace. All right, so shifting gears, Opendoor sheds more employees following NASDAQ delisting threat. This is according to Inman. Quote, Opendoor let go of another 40 employees on Wednesday in what the company is describing as a targeted restructuring within its sales operation as it seeks to reverse an ongoing string of losses and build new revenue streams outside of buying and selling houses, Inman has learned exclusively. According to an internal email obtained by Inman and a confirmation from the company, Opendoor said it implemented its latest round of staff reductions. The layoffs were the latest in a series of restructuring and maneuvers aimed at finding a path toward profitability and growth after the company rose to become the largest and one of the only remaining large-scale iBuyers. The latest shift follows a trend for the iBuyer, which has posted collective net losses of nearly $2.8 billion in the 18 quarters since going public in its quest to buy homes and sell them at a profit. But while the company scaled to become the largest within the iBuying sector, it has consistently struggled to post a profit and has in recent years sought to evolve beyond the core iBuying concept. Opendoor has posted a profit during just 2 of the past 18 quarters, according to the company's earnings reports dating back to the fourth quarter of 2020 when the company went public. In that same time, other companies that had also had significant iBuying segments, perhaps most notably was Zillow, abandoned the attempt to profit from iBuying at scale. Meanwhile, Opendoor's cash and cash equivalents has fallen 76% from its peak in early 2022, when it was using some of its $2.3 billion to ramp up its home buying efforts amid a red-hot market. At the end of the quarter, when Opendoor reported an $85 million loss, the company had $559 million in cash and cash equivalents, unquote. So Opendoor continues to bleed money, and its runway is now relatively short. If losses continue at this current rate, it could run out of working capital within the next couple of years, unless they're able to raise additional capital. Now, speaking of Opendoor, the company actually just agreed to a $39 million settlement. This is according to RIS Media. Quote, according to court filings last week, Opendoor is paying $39 million to a group of investors, including pension funds and individuals, who back in 2022 sued the company alleging that it had made materially false and misleading statements and omissions regarding its ability to buy and sell homes for a profit. Opendoor is not admitting wrongdoing, and it is not agreeing to make any practice changes as part of the agreement, which still needs final court approval to become effective. Plaintiffs allege that Opendoor previously made partially corrective disclosures regarding its tech and algorithms, which caused the company's stock to plummet and harmed investors. A judge previously found that the plaintiffs had provided at least some evidence that Opendoor's claim that its algorithms can dynamically adjust to leading market indicators and react to real-time macro and microeconomic conditions was a violation of securities laws. As the housing market started changing in 2022, investors continued to rely on defendants' false and misleading representations about Opendoor's ability to quickly adapt to those changing market conditions, the plaintiffs claimed in the complaint. Plaintiffs relied on 8 whistleblowers or confidential witnesses who reported that Opendoor eventually had to ask real estate agents to help move properties that were stuck on the market, allegedly because algorithms could not price them accurately. The automated system ran into other issues, and the whistleblowers alleged that Opendoor did not do any research on markets it was trying to enter, unquote. Now, speaking of lawsuits, Keller Williams was just hit with another telemarketing lawsuit. This is according to Real Estate News. Quote, Keller Williams Realty is facing a new telemarketing lawsuit alleging that the brokerage contacted an individual by phone despite their number being listed on the National Do Not Call registry. The complaint filed in the U.S. District Court for the Western District of New York on June 12th alleges that KW made contact in violation of the Telephone Consumer Protection Act. The lawsuit is seeking class action status. The complaint was filed by Sidney Thayer, a resident of Rochester, New York, who has no existing business relationship with Keller Williams, according to the filing. Thayer allegedly received multiple unsolicited text messages from Keller Williams between April 2024 and March of this year, all of which constitute telemarketing. Keller Williams utilizes aggressive marketing to push its products and services without regards to consumers' rights under the TCPA, the complaint alleges. This conduct resulted in the invasion of privacy, harassment, aggravation, and disruption of the daily life of thousands of individuals, it added. The lawsuit's proposed class would include individuals who received more than one unsolicited marketing text message from Keller Williams in a 12-month period, dating back to 2021, despite their phone number being listed on the Do Not Call registry. Thayer is seeking up to $1,500 per call or text, allegedly made in violation of the TCPA. The anticipation that the class could be in the tens of thousands or more, the complaint suggested in total and sought damages could exceed $5 million, unquote. Now, it's worth pointing out that the actions of one real estate agent at one local franchise location shouldn't necessarily be imputed upon the actual national franchise company, Keller Williams Realty International. Unless that's part of the culture, part of the training, if the decision's being made at a local franchise office or by a certain real estate agent, I don't know if they really are going to have standing to go after the national company unless they can prove that they were complicit. Really, I think that they should be suing the market center, is what Keller Williams calls them, which is the local franchise operation. However, that being said, it is really, really important that as an industry, we are compliant with the TCPA, the Telephone Consumer Protection Act. I've made this point on the show several times that TCPA lawsuits are through the roof right now. If I remember correctly, I believe they were up about 40% last year from 2023 to 2024. So if prospecting is part of your business strategy as a real estate agent, if you're calling people that have not provided, or texting, if you're calling or texting people that have not provided you with express written consent, you need to be checking the Do Not Call registry. If you're a broker owner, you need to be providing not only training, but the tools for your agents to actually do this in practice. It's not enough, I think, just to teach them that this is what you should do. A lot of agents know they're supposed to do this, but they don't know how to do it. They don't necessarily have access to the Do Not Call registry. So I think if you're a broker owner, it's really important, again, not to just train on this, but to provide a tool for your agents to be in compliance. Here at Bluefield, we use a software called Easy Verify. It integrates directly with Follow Boss, but I believe that at this point they have other CRM integrations as well. I highly, highly recommend it. All you do is you put your lead in there and it'll automatically check the phone number against the Do Not Call registry. I'm not being paid to recommend them. It's just a great product that we use here. You can check them out at easyverify.ai. All right, so in other news, the Secret Service has warned NAR of a crypto scam targeting real estate agents. This is according to RAS Media. Quote, if it sounds too good to be true, it most likely is. During an MLS forum at the National Association of Realtors legislative meetings, Senior Counsel and Director of Legal Affairs Charlie Lee touched on just that, warning real estate professionals of a new cryptocurrency scam called pig butchering. The U.S. Secret Service is aware of at least 40 real estate professionals who have fallen victim to this cryptocurrency scam. It is likely to grow, and we just want to alert all of you of the scam so that you can make sure that your members are aware and your colleagues are aware, Lee said, addressing the ballroom packed with real estate professionals. According to federal investigators, scammers pose as high net worth individuals looking to buy homes in all cash. Throughout the course of the relationship, the scammer builds relationships with the real estate professionals to the point where they're asked how they built their wealth. The scammer then points to cryptocurrency. Over time, as the relationship builds, the real estate professional will express interest in the space, and the fraudster will lead the real estate agent to a platform or website featuring a lot of cryptocurrencies that resemble legitimate cryptocurrency, Lee said. After small investments and subsequent returns, the real estate professional will cash out and liquidate more assets, which often include their retirement accounts. Then, as you imagine, they lose all their money, Lee explained. According to Wikipedia, pig butchering scams originated in 2016 or earlier as a regional scam in China, originally finding their victims on dating sites. The unpleasant term comes from the analogy comparing the initial phase of gaining the victim's trust to fattening of pigs before slaughtering them, unquote. So if you're ever in a situation, moral of the story, if you're ever in a situation where a client is asking you to invest in a cryptocurrency, in a business, in any type of investment, don't do it. Unless this is someone that you have actually completed multiple transactions with and you know they are legit, do not do it. Just because you have someone posing as a high net worth individual, even if they've sent you proof of funds that looks legitimate, if you have not actually closed on an investment with them, it is not wise to do any type of investment, either with them directly or in a third party that they might recommend. And even after closing on transactions with them, that may not be something that you want to get involved with. So just exercise some caution there. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to all of today's articles at realestatebackstage.com/episode 32. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.